Hey, this is Darren from Property Prosperity, and today I thought I'd have a little bit of chat about negative gearing. It's getting close to the election coming up, and both the sides are having arguments about whether negative gearing is a good thing and a bad thing, and whether they should change the policies of negative gearing, and whether it benefits the rich people or the poor people, or whether it helps the property market go up or down, and whatever it does. So I thought I'd just explain what it is first of all, because some people probably still don't know what it is, and you hear it all the time. Hey, Isaac, thanks for joining. You hear it all the time, and people think they may or may not know what it means. But and the problem is sometimes people use it in the wrong sense as well, and so it's just considered a bit of a catch-all for anything to do with property investment, I think, sometimes. So the thing to understand, it's related to when you buy a property and the rent you receive for the property is actually less than it costs you to own the property. So basically that means the property is costing you money. So which isn't a good thing at the end of the day. If you're buying an investment and it's costing you money, it's not so good. It's like putting your money in the bank and the bank taking out fees and charges, so it's actually costing you money to put in the bank. So doesn't seem like a really good idea on paper, and it's probably not really a good idea, I suppose. So firstly, before I start talking about what negative gearing is, I suppose I'd just let you understand why people would buy a property and actually it would cost them more money than actually generating income. So it seems a bit crazy why someone would do that, but you got to understand people aren't purely buying an investment property for cash flow, they call it, for money in their pocket. So you got cash flow, which is the rent compared to what it actually costs. There's cash flow, which is the rent compared to what it actually costs you to hold the property, but also there's capital gains, and that's the increase in value of the property. So generally people are focused on capital gains as the value of the property increasing over time. And so they're willing to bear a bit of the issue of the fact that the property is costing them money, because they're hoping over the long term, they're hoping for the whole, property doubles every 10 years scenario. And so they're like, hey, I don't care if it's costing me, $50 or $100 a week over time, because over time I know that, in the long term I'm going to have all these capital gains, and that's going to offset some of those little small losses I've had from the cost of owning the property. So that's the first thing to understand why. And you probably find one of the reasons why property doesn't seem like a good investment, in the fact that it's costing you more money than than it returns, is if you're, say, buying shares. Shares is actually purely an investment that you're buying to make money, really. So you wouldn't be buying a share unless it's putting money in your pocket. Either you think the price is going to go up, or you get dividends returns, right? So it's purely a financial decision. The thing to understand, when people are buying property as an investment, it's not just people buying a property as an investment. There's people buying property to live in as well. So that's what's going to skew the market with property, that there's not purely focused on rental returns and capital gains. It's also focused on the fact that, it's close to my work, and my mum lives down the street, and, my kids go to the local school. So I'm willing to pay more for this house than an investor would, because I can see the value in not having to drive so long to get to work. So what that means is some of the properties, generally you find where there's lots of demand and not much supply, then the rental returns aren't as great. So what is called yield, the return relative to the cost of the property, is not as great. And then areas where people don't want to live, then you generally find there's better rental returns, because you have to justify why someone would buy that property. And so generally that's for rental returns. So understand then that property is a little bit different to buying shares. So in the fact that quite often you can buy a property and actually be losing money on it over the short term in the hope for capital gains. So that's the logic behind losing money on a property, which sounds a bit crazy. Then the next question is, what is this whole negative gearing thing? So basically negative gearing, in its true sense, means that I'm losing money on that property. I might have my day job. I might be earning 100 grand a year in my day job. And then I've got an investment property that costs me, say, 40 grand a year to hold on to the property. And I'm, my income coming from the property is 30 grand a year. So each year it's costing me $10,000 per year to hold on to the property. So that $10,000, what the government allows you to do is then reduce your income, your taxable income. So if I'm earning $100,000 that year, I can get the $10,000 I lost in the property, and I can transfer that across to my taxable income for my day job. And so instead of paying tax on $100,000, I'm going to pay tax on $90,000. So it means I'm paying less tax than I otherwise would, because I'm paying on a smaller taxable income. So At the end of the day, I think it's pretty fair enough. Really, all that is you have made a loss, and it is you making a loss on the property. It is you have made a gain by having your day job, so there's not really much reason why you can't offset one against the other. What they argue is that they're different income sources, and so you should keep them separate, just like separate businesses or separate entities or whatever. But at the end of the day, I don't think it makes a big deal or difference. So I think it's probably okay, fair enough, really. The other thing they talk about when they, sometimes people put in the catchphrase of negative gearing, which isn't negative gearing, is claiming depreciation deductions. So depreciation is totally different thing. Depreciation means you're claiming a deduction on your tax as for any costs associated with trying to make money, basically. And so if you ran a business and you're spending money on marketing or whatever else associated with the business to try and make money, you can claim a deduction on that cost. So likewise with a property, you can claim a deduction on the property itself because basically the property is wearing out. If you buy, even just things like you buy a garden hose or you buy some consumable items, you can claim that as a tax deduction because that's going towards your investment property, which is geared to make your money, basically. And so likewise, what they do for a property, for say the building, it might be, might last for 30 years. So they'll let you claim tax deductions over 30 years. And there'll be different depreciation rates for different items in the property. So it might be, tiles will have a different depreciation rate than timber, laminate or carpet, or your air conditioner will have a different rate to your oven. And so basically they spread it out over what they call the useful life of the asset. Doesn't necessarily mean that that's how long the asset's going to last for, but the government, the tax man, has to decide on a value. So he just assigns a value you can claim as a deduction, basically. So sometimes what happens, you can claim all your deductions as if say the oven is totally worn out, but in reality it's still working fine. But as far as the tax man's concerned, you have that property, that oven essentially as past its use by date and is no longer of any value, and you need to replace that oven or whatever is included in the house. So when you're claiming that tax deduction for the oven or the carpets or the building or all that sort of structure, you're not really getting any benefit from that because you're claiming a deduction, and the reason the tax man is allowing you to claim a deduction is because at some point in time you have to replace that asset. So even though it looks on paper it looks like a good idea that I'm claiming X amount of dollars per year, in reality you should be putting that money aside because that money is going to go towards replacing that asset when you need to replace it. The oven or the flooring or the air conditioning or the building itself is going to wear it over time. So in reality, claiming a tax deduction for depreciation, it seems like a good thing because you're minimizing your tax, but in reality, you don't get it in your pocket. You can't really spend it because in theory, you should be putting that money aside for the future when you're going to have to reinvest back in the building at some point in time. So that's what depreciation is. It is a different thing from negative gearing. The other thing that sometimes people talk about when they talk about negative gearing is the tax exemption you get when you, a capital gains tax 50% exemption you get if you hold the property for more than 12 months. So this is another thing that's totally different again. So again, if I'm not making sense here, feel free to put a little comment box and want me to clarify, and I'll try and expand a little bit further. And again, if you like what I say, click on the like button. If you don't like what I say, then click on the like button too. So, okay, so the 50% capital gains tax exemption. Basically what that means is, as far as the tax man's concerned, he's trying to get you to hang on to your property for a longer period of time. So he doesn't want you to buy it and sell it and buy it and sell it, and which they sometimes called flipping properties, or just they don't really want developers coming in there and buying and selling, or mums and dads going and buying and selling property, because they just think it's just not good for the property market. They want it to be a lot more stable. So what they do is to try and give you an incentive to hang on to the property for longer than otherwise. We pay something called capital gains tax, which basically means that's the tax we pay on the profit we make from buying and selling a property. So if we buy a property for $100,000 and we sell it for $150,000, then in theory we've made $50,000 profit, or gain, they say. And so you'll pay tax on that $50,000 gain then. When they talk capital gains tax, in reality, you're actually just paying it at your marginal tax rate, just as like you had a day job. So that's just like you earning 50 grand a year in your day job. The issue people get though is because it's a marginal tax rate, actually as you start earning more and more, you get taxed more and more. So at the start, you don't get paid, you get tax 0, and then you'll get a smaller percentage and another percentage until you get up to like 50% tax you're paying. So the issue people are concerned with as far as capital gains tax goes is at the start, if they've got their day job and they're earning 50 grand a year, they're not paying very much tax on that 50 grand a year, but suddenly if they made a $50,000 gain on their investment property, that $50,000 gain comes into the top margin, or their top marginal tax rate. It might not necessarily be the top tax rate, but it's the highest percentage they're paying. And so for the owner, it seems like they're paying out crazy amounts of tax on that $50,000 gain. So people don't necessarily like paying tax, so people look at that as a bad thing. So what the government does to try and give you an incentive to hang on to the property a little bit longer. So if you make a $50,000 capital gain, if you bought it and sold it quite quickly within a few days or a month or 6 months, then you'll have to pay that your full marginal tax rate. Where what the government does, if you hang on to it for more than 12 months, they'll actually give you a 50% discount that you'll pay capital gains tax on. So in theory, if we make a $50,000 capital gain, the government will give you a 50% discount on that capital gain, so they'll reduce it down to $25,000 and you'll pay tax on the $25,000. So you can imagine that's a massive difference in savings that you're going to make on tax you otherwise would have to pay. So they're the three things that you probably should be considering. So the negative gearing thing is really more about shifting your income between your income or your loss between the property and your personal income. The depreciation is a separate thing. That's just claiming a deduction for the property as it's wearing out. And then you've got this capital gains tax exemption, the 50% capital gains tax exemption, which is trying to give you an incentive to try and hang on to the property for a bit longer. The cool thing about the 50% capital gains tax exemption is you're basically claiming the full deduction, but then you're paying tax on only half the gain. So it works out pretty good for the investor. So that's a pretty cool thing. And that is an incentive for people to get into property. Probably more of an incentive than the negative gearing side of things, and more of an incentive than the depreciation side of things. It does give you an incentive to buy property because you can claim all the deductions and you only have to pay half the tax on the profits, so which is a pretty cool thing. So the other thing, so what the politicians are arguing about at the moment, they're firstly arguing about the negative gearing thing, where they should allow you to be able to claim tax deductions for things that for income produced otherwise than something other than your personal income, as far as your day job. But also what they're arguing about is whether you should be able to claim that 50% capital gains tax exemption on, or they should make it smaller, like a 25% capital gains tax exemption, so it's not quite so lucrative for the people to buy properties. The other thing they're talking about is not letting you claim that deduction at all unless it's a brand new property. So if it's a brand new property, the reason governments like people buying brand new properties rather than older properties is because they're worried if you buy an older property, or you've got an incentive to buy an older property, suddenly the market wants to buy lots of older properties. You're not actually creating any more stock of properties. And all you're doing generally is increasing the value of property overall, which makes it harder for people to get into the market and buy a property. And generally then they say then it's harder for renters to be able to get into the market. You're not increasing the supply of property, so that means that less, not much supply and lots of demand means house prices are going to go up, basically. So by skewing the tax benefits towards new property, then what that does is it then provides incentives for investors to then build instead of buying existing properties. And because they're buying, they're actually increasing the value of increasing the supply of properties, which hopefully reduces the demand for properties and also decreases the prices, so allows it a bit cheaper for people to get into the market. Hey Lisa, thanks for joining. Hope your twins are going okay, hopefully in their better sleep. So yeah, hopefully that's made sense. So the thing to understand about negative gearing, there's three things to think about. So it's can we shift our income between the property and our personal, day job? Can we claim the depreciation deductions, which is not negative gearing, it's a separate thing, and also the 50% capital gains tax exemption, which is something they're more talking about, where they try and switch it between newer properties or not, and put more supply of properties on the market. So hopefully that's made sense, and I've gone around circles a little bit and explained it a few times, but yeah, people get a little bit confused by sometimes about how it all works. But yeah, if it seems to make sense to you, click on the like button. If it hasn't, then click on the like button. I'll try a bit harder for next time. And if you think someone might get some use out of it, click on the share button. And if you've got any questions or something you want to know about in the future, then feel free to put a little comment in the comment box and I'll try and answer your question next time. Thanks guys, and we'll talk again soon. Bye.